This content reflects my personal views and current market trends. It is provided for informational and educational purposes only and does not constitute financial, investment, or trading advice. I am not a licensed financial advisor. Always conduct your own research and consult with a qualified professional before making any investment decisions. Today we're breaking down a major macro shift that could reshape everything from interest rates to global capital flows, and it's flying under the radar. You're about to see a global market shakeup that nobody's talking about yet. It's not coming from Wall Street, it's coming from Beijing, and it could hit Europe like a deflationary tsunami. Here's what's happening. President Trump has just announced a 145% tariff on Chinese imports. That's not a typo. 145%. And while that may drive prices up in the US, the effect in Europe could be the opposite. Let me explain. China is the world's largest exporter. When the US imposes such steep barriers, China doesn't just stop exporting, it redirects. And the most likely destination? Europe. To stay competitive, Chinese companies may need to lower their prices significantly just to keep export volumes steady. That opens the door for a surge of low-cost Chinese goods hitting European markets. The result? A deflationary wave that could pull prices down across the continent. Now let's look at how this may ripple through the markets, starting with bonds. If inflation trends lower in Europe, the European Central Bank may respond by cutting interest rates to stimulate demand. Rate cuts generally make borrowing cheaper and support economic activity. And here's where bond markets come in. When interest rates fall, existing government bonds issued at previously higher rates often become more valuable. They pay out more compared to new bonds, which makes them more attractive to fixed-income investors. That's why some market participants are starting to favor European government bonds over U.S. Treasuries, especially if the Federal Reserve maintains higher rates to manage U.S. inflation. Now shifting to equities. U.S. stocks currently trade at a significant valuation premium, roughly 50% higher than their European counterparts. But with the potential for rising inflation in the U.S. and disinflation, or deflation in Europe, some investors see room for that valuation gap to narrow. The thinking is, if European companies benefit from lower input costs and more price stability, while U.S. firms face margin pressures, global capital could start to rebalance. Until valuations normalize, say closer to a 25% premium, some investors are maintaining an overweight exposure to European equities. Now let's talk currencies. This part's a bit more nuanced. If China allows its currency, the yuan, to depreciate in response to tariffs, that move could exert downward pressure on other emerging market currencies. Why? Because when Chinese goods become cheaper, competing exporters may need to weaken their currencies too, just to stay competitive. At the same time, rising inflation and concerns about U.S. fiscal stability could prompt capital to flow out of U.S. assets. But Europe won't necessarily benefit from that flow directly, especially if rate cuts pressure the euro and the pound. So where does that capital go? Often, it moves into traditional safe haven currencies. That's why many investors are watching the Japanese yen and Swiss franc right now. They've historically been favored during periods of uncertainty and risk-off sentiment, and this environment could bring them back into focus. Here's how some investors are thinking about the next 6 to 12 months in FX. Underweight. Emerging market currencies, neutral. US dollar, euro, British pound, overweight, Japanese yen, and Swiss franc. And here's one last macro theme worth watching. Right now, interest rate futures suggest that markets expect more rate cuts from the Fed than from the European Central Bank. But if Europe experiences a deeper deflationary shock than anticipated, the ECB could end up easing more aggressively. That's led some strategists to position long on euro interest rate futures versus Fed fund futures. So to sum it up, U.S. tariffs may push domestic inflation higher, but could unleash deflation in Europe. That deflationary pressure may lead to rate cuts in Europe, which could support European bond prices. The stock market could see capital rotation from richly valued U.S. equities to more discounted European names. In FX, emerging market currencies look vulnerable, while capital may rotate into the yen and Swiss franc. And finally, Some market participants anticipate that the European Central Bank may adopt a more aggressive rate-cutting cycle than is currently reflected in market pricing. These are the types of global shifts that can reshape entire portfolios, so it's worth paying attention. Hit that like button if this breakdown helped you see the big picture, and don't forget to subscribe for more deep dives into global markets.